What if I told you that the most powerful retirement strategy ever discovered requires zero stock-picking skills, zero financial expertise, and less than 30 minutes of setup? And what if I told you that the people who have used this strategy, ordinary teachers, nurses, truck drivers, government workers, have retired in their 40s, some in their 30s, not because they earned more than you, because they understood one thing that most people never figure out. The stock market does not reward the smartest investor. It rewards the most patient one. And the tool that turns patience into generational wealth has been sitting in plain sight this entire time. If nobody ever showed you how index funds actually work and why they quietly outperform almost everything else over time, smash that like button right now, because this is the video that changes how you think about retirement forever. I'm Alex. I study how financial behavior, investing psychology, and long-term strategy shape the wealth outcomes of people who started with nothing extraordinary. And today, I want to walk you through the complete framework for retiring early using index funds. Not a surface-level explanation. The full picture. What index funds actually are, why they work mathematically, the specific numbers that make early retirement possible, the behavioral traps that destroy most investors before they get there, and the exact system to set up so the whole thing runs without willpower. This is an 8 to 12-minute video. Stay until the end, because the final section on behavior is the part most people never hear. Let us build this properly. Here is the sentence most people never say out loud. I am trading the best hours of my best years for a paycheck that barely covers my life. And the plan, the widely accepted plan, is to do that for 40 to 50 years. Then retire. Then enjoy the freedom you spent your entire working life waiting for. Think about what that plan actually requires. You spend the years when you have the most energy, the most health, the most capacity for adventure, sitting in meetings, commuting, performing for a salary, and then at 65 you receive your freedom. When your knees hurt, your parents may be gone, your children are grown, and your body has less tolerance for the things you were saving money to do. That is the standard plan. And most people never question it. But here is what the math shows when you run it honestly. You do not need 40 years of work to fund 30 years of retirement. You need a specific ratio between what you earn, what you spend, and what you invest, maintained consistently over a much shorter period. And that ratio, when you hit it, produces a number called your financial independence number. The moment your invested assets generate enough passive income to cover your living expenses, you are done. Not at 65. Whenever you hit the number, that is what early retirement actually means. And index funds are the most reliable vehicle for reaching that number that ordinary people have ever had access to. Let me explain index funds the way nobody ever did in school. Imagine you walk into a casino, but instead of betting on individual games, you buy a piece of the entire casino. The roulette table, the poker room, the slot machines, the restaurant, the hotel rooms, all of it. Now, even when some games have a bad night, the casino as a whole keeps producing because you did not bet on one game. You bought the house. That is what an S&P 500 index fund is. The S&P 500 is a collection of the 500 largest publicly traded companies in the United States economy. When you buy a single share of an S&P 500 index fund, you are buying a fractional ownership stake in all 500 of those companies simultaneously. Apple, Microsoft, Amazon, JP Morgan, Johnson & Johnson, all of them in one transaction. And when one company struggles and falls out of the top 500, the index automatically removes it and replaces it with a stronger company. You do not make that decision. The index does it for you. This is the self-cleaning portfolio. It fires its losers and promotes its winners automatically while you do nothing. Now, here is the number that makes this matter. Over the past century, including 2 world wars, 16 recessions, the Great Depression, the 2008 financial crisis, and the 2020 pandemic, the S&P 500 has delivered an average annual nominal return of approximately 10.5%, according to Robert Shiller's Yale University dataset. Let me translate that into actual dollars. $500 per month invested at 10% average annual return for 30 years becomes approximately $1,130,000. Not from skill, not from timing, from showing up every month and buying the index regardless of what the news said. That is the power that has been available to every ordinary person, and almost nobody has been shown how to use it. Here is something the financial industry would rather you not think too hard about. Every year, thousands of professional fund managers, people with Harvard MBAs, Bloomberg terminals, research teams, and access to information you will never seize, compete to beat the market. And according to S&P's Spiva report, the most comprehensive study of investment performance ever conducted, over 90% of actively managed funds, a simple 500 index fund, over 15-year period, over 90%. These are not amateurs. These are the most qualified investors on earth, and most of them cannot beat the index consistently. Now, think about what this means for you. If the professionals cannot beat it reliably, why would you try to pick individual stocks? Why would you pay someone to actively manage your money? When over a long enough time horizon, the passive index wins most of the time. And here is the part that actually costs people money. Actively managed funds typically charge 0.5% to 1.5% in annual fees. Low-cost index funds, like those from Vanguard, charge as little as 0.03%. That difference sounds tiny, but on a $500,000 portfolio, the difference between a 1% fee and a 0.03% fee is approximately $4,850 per year leaving your account. Every year. Over 20 years, that fee difference compounds to over $200,000. $200,000. Gone. Not to bad investments, just to fees. The low-cost index fund is not just a better investment strategy. It is a fee avoidance strategy. And over a long investing life, the fees you do not pay compound just as powerfully as the returns you keep. Let us slow down for a second. An index fund is a single investment that gives you ownership in hundreds or thousands of companies simultaneously. The S&P 500 has averaged approximately 10.5% annually over a century through every crisis imaginable. Over 90% of professional fund managers cannot beat it consistently over 15 years. Low-cost index funds eliminate the fee drag that quietly destroys hundreds of thousands of dollars in long-term wealth. Now, here is where the early retirement piece enters the equation. To retire early, you need to understand one concept that nobody teaches in school: the financial independence number. Think about a vending machine. You put money in. The machine produces output. You consume the output. The machine keeps producing. Your investment portfolio is that machine. The question is, how much money do you need inside the machine for it to produce enough output to fund your entire life, forever, without ever running out? The answer comes from research that changed the entire financial independence movement. In 1994, financial researchers William Bengen published what became known as the 4% Rule. The study analyzed historical market data across multiple economic cycles, including depressions, recessions, and wars, and found that a retiree who withdrew 4% of their portfolio in year one, adjusted for inflation annually, had a very high probability of their portfolio lasting 30 or more years. In plain terms, if you have a portfolio worth $1,000, you can safely withdraw approximately $40,000 per year to live on. The portfolio keeps growing through market returns while you draw income from it. That is the machine producing output. Now let us make this personal. To find your financial independence number, take your annual living expenses and multiply by 25. If you spend $40,000 per year, your financial independence number is $1,000,000. If you spend $60,000 per year, your number is $1,500,000. If you spend $30,000 per year, your number is $750,000. The single most powerful lever available to accelerate early retirement is reducing your annual expenses. Not because deprivation is the goal, because every dollar you do not spend does two things simultaneously. It reduces the number you need to hit, and it adds to the investments that are compounding toward that number. That double impact is why spending behavior is the most underrated variable in early retirement planning. Here is the chart that most financial planners do not show you, because it challenges the entire industry narrative. Your savings rate, the percentage of your take-home income that you invest, determines when you retire more than almost any other single variable. Let me show you the real numbers. Show retirement timeline by savings rate. If you save 10% of your income at standard market returns, you will be ready to retire in approximately 43 years. If you save 25% of your income, approximately 32 years. If you save 50% of your income, approximately 17 years. If you save 65% of your income, approximately 10.5 years. Not career length, not your starting salary, not your investment returns. The percentage of your income that you invest determines how quickly you arrive at your financial independence number. Let me make that real in dollar terms. On a $60,000 take-home salary, saving 10% means investing $6,000 per year. Saving 50% means investing $30,000 per year. At a 10% average annual return, the 10% saver reaches $1,500,000 in approximately 43 years. The 50% saver reaches the same number in approximately 17 years. Same salary, same return rate, 26 years faster. I know what you are thinking right now. Alex, I cannot save 50% of my income. My rent alone takes half of what I earn. And here is the honest response. 50% is not the starting point. It is the destination for the most aggressive early retirement timelines. But even moving from 10% to 20%, from $6,000 to $12,000 per year invested, reduces your retirement timeline by approximately 8 years. 8 years of freedom from one behavioral change. The question is not whether you can get to 50%. The question is, what is your current savings rate? And what is one specific action you can take this week to move it higher? Here is where we are. The financial independence number is your annual expenses multiplied by 25. The savings rate is the master variable. The higher it is, the faster you arrive. Moving from 10% to 20% savings shaves approximately 8 years off your timeline, not because you earned more, because you invested more of what you already had. Now here is the part that most index fund content completely skips: the behavioral traps. Because knowing the strategy is not enough. Most investors who understand index funds still underperform them, not because of returns, because of behavior. Let me introduce you to the single most documented fact in all of investing research. The average investor consistently earns lower returns than the funds they are invested in. Let that sink in. The fund returns 10% per year over 20 years. The average investor who owns that fund earns around 7% or 8% over the same period. Same fund, lower return. How is that possible? Because people do not buy and hold. They buy when the market is rising. Prices high, confidence up. They sell when the market is falling. Prices low, fear dominating. They buy high and sell low. The exact opposite of what builds wealth. And they do this not because they are stupid, but because the financial decisions are made emotionally, not logically. People do not make financial decisions logically. They make them emotionally. And here are the 4 specific emotional traps that destroy early retirement plans before they ever compound. Trap 1. Panic selling during market crashes. Think about what a market crash actually is from a long-term investor's perspective. Everything is on sale. If your favorite store put their products at 40% off, you would not run away from the store. You would buy more. But when markets drop 30% or 40%, most investors do the opposite of what they should do. They sell. They lock in the loss, and they miss the recovery that every single major crash in history eventually produced. The 2008 financial crisis bottomed in March 2009. By 2013, the S&P 500 had fully recovered and reached new highs. The 2020 pandemic crash lasted 33 days. It was the fastest recovery from a 30% decline in market history. Every single crash, every single one, followed by a recovery. The investors who held, or better, bought more during the crash were rewarded. The investors who sold locked in permanent losses and missed the recovery. Practical rule: when markets crash, do nothing, or buy more if you have the cash reserves. Never sell out of fear. Trap 2. Market timing. Imagine you are trying to jump on a moving train. You wait on the platform. The train pulls in. You think it will slow down more. I will wait for the perfect moment. The train accelerates. You miss it. You wait for the next one. That is market timing. Research from Fidelity Investments found that the investors with the best long-term portfolio performance were, and this will surprise you, the investors who forgot they had accounts or died. Not the active managers, not the sophisticated timers. The people who set it up and did nothing, because trying to time the market means missing the best days. And according to JP Morgan research, if you missed just the 10 best trading days in the market over a 20-year period, your total return was cut nearly in half. 10 days, over 20 years. Missing the 10 best days, which are almost always during periods of maximum fear when most people have already sold, cuts your 20-year return almost in half. Practical rule: time in the market beats timing the market. Set up your automatic investment. Never override it. Trap 3. Lifestyle inflation. Here is the silent retirement killer nobody talks about. Every time your income increases, your expenses have a natural tendency to increase with it. New job, new apartment, new car, better restaurants. And your investment amount stays roughly the same because the lifestyle absorbed the raise. This is called hedonic adaptation, researched and documented by behavioral economists, including Nobel Prize winner Richard Thaler at the University of Chicago. Your brain quickly normalizes new comfort levels and pushes for the next upgrade. And here is the mathematical devastation of that pattern. At $60,000 income, savings 20% means $12,000 per year invested. You get a raise to $80,000. Instead of bumping investments to $16,000, lifestyle inflates to absorb the raise. Investments stay at $12,000. That $4,000 per year difference invested at 10% over 20 years. is approximately $229,000. Not from not investing at all, from not increasing the investment when the income grew. Practical rule: every time your income increases, your investment percentage increases before your lifestyle does. Pay your future self the raise first. Trap 4. Account checking obsession. Here is one of the most counterintuitive findings in all of behavioral finance. The more frequently you check your investment accounts, the worse your long-term returns tend to be. Because frequent checking triggers frequent emotional reactions. A down day, a red week, a scary news headline, and every reaction is an invitation to do something, when doing nothing is often the optimal strategy. Research by Shlomo Benartzi at UCLA and Richard Thaler found that investors who reviewed their portfolios monthly made significantly more emotional trades than those who reviewed annually, and ended up with meaningfully worse outcomes. Practical rule: check your accounts quarterly at most. Set up automatic investments. Trust the system you built, and let the compounding do its work without emotional interference. Here is the most important insight in this entire video. Your financial success should not depend on your willpower. Willpower is finite. It runs out. It has bad days. It responds to mood, stress, fatigue, and social pressure. A system does not. And index fund investing, set up correctly, is one of the most powerful financial systems available. Here is exactly how to build it. Step 1. Open a low-cost brokerage account with a provider like Vanguard, Fidelity, or Schwab. All three offer zero-expense ratio index funds. Your account should take less than 30 minutes to open. Step 2. Set up its automatic investment on a fixed schedule. Weekly, bi-weekly, monthly. Whatever aligns with your paycheck. The investment leaves your account automatically on that date before you can spend it. This is the single most important behavioral move in the entire strategy. Because if the money never appears in your spending account, you never have to decide whether to invest it. The decision has already been made. Step 3. Choose a simple fund or a combination. For a beginner, a total stock market index fund or an S&P 500 index fund is a complete starting point. As your knowledge grows, you can add international exposure or a bond component for diversification. Step 4. Never override the automatic investment. Mark it up, it buys. Mark it down, it buys. News is terrifying, it buys. The system does not read the news. Step 5. Review quarterly, not to react. To confirm the system is running. That is the entire system. No financial genius required. No daily attention required. No willpower required. Just a system that runs quietly in the background, month after month, compounding toward your financial independence number. Do your own research before making any specific investment decisions. Talk to a qualified financial advisor if needed. Every investment carries risk, but this framework, the behavioral discipline of consistent automatic investing in low-cost index funds, is the foundation that has produced more ordinary millionaires than any other investing approach in history. Let us lock in everything. Index funds give you ownership in hundreds or thousands of companies through a single investment. They are self-cleaning, removing losers, promoting winners automatically. The S&P 500 has averaged approximately 10.5% annually over a century through every crisis imaginable. Over 90% of professional fund managers cannot beat a simple index fund over 15 years. Low-cost index funds eliminate fee drag that quietly destroys hundreds of thousands of dollars over a lifetime. Your financial independence number is annual expenses multiplied by 25. Your savings rate is the master variable. Moving from 10% to 20% savings shaves approximately 8 years off your retirement timeline. 4 behavioral traps destroy most investors: panic selling, market timing, lifestyle inflation, and account obsession. Know them. Design your system to prevent them. The system beats willpower. Automatic investments set and left running, without emotional override, is the entire strategy. The stock market does not reward the smartest investor. It rewards the most patient one. And patience is not a personality trait. It is a system. Set the system up, let it run, and let the mathematics do what the mathematics always does. Given enough time. The difference between being stuck and being free is not income. It is behavior repeated quietly.